Right now, at 2:50 p.m. Eastern Time on October 28, 2025, shares of Nuburu, ticker BURU, are trading at $0.3776. That's a drop of about 4.4% on the day. But the price is almost irrelevant. The real story is the volume. We are seeing an absolutely staggering 62.3 million shares change hands. To put that in perspective, the entire company has a market cap of under $50 million. This is a complete and total churn of the float. The immediate expectation for anyone just glancing at this, maybe on their Robinhood app or SoFi Invest platform, is that this must be a catastrophic failure of its core business. The reality is far more complex and frankly bizarre. This isn't just about blue lasers anymore. This is a company in the middle of a desperate, high-stakes pivot into the defense and drone industry, and today's volume is the battlefield between narrative-driven retail traders and a mountain of short sellers. The common ground, the story that most people who bought this stock months or years ago believe, is that Nuburu is the blue laser company. The expectation was built on their proprietary technology, which is supposedly far superior for welding conductive materials like copper. This, in theory, makes them a critical supplier for the EV battery and electronics manufacturing boom. It's a fantastic story. It sounds like the kind of investment that could be the next Nvidia stock. But that narrative has completely stalled. The reality is that this high-tech industrial adoption is brutally slow, and in the meantime, the company is bleeding cash. We're talking about a company that, based on its last quarterly update and a recent capital raise, appears to be burning through millions per month. The $12 million they raised in September might be nearly gone. So the new reality, the one the market is grappling with today, is that management has initiated a radical change in direction. They are attempting to use the public shell of Nuburu to acquire other companies, specifically in the European defense and security space, like Tekne and Orbit, and just this month announced a joint venture with Maddox Defense for drones. This isn't a tech adoption story anymore, it's a complex international M&A roll-up story being bolted onto a cash-starved R&D firm. Let's dissect today's movement, because it's the most important factor. That 62 million share volume is not institutional accumulation. A look at the filings shows institutional ownership is almost non-existent, less than 1%. This isn't Fidelity or a Schwab Intelligent Portfolios account building a position. This is pure, unadulterated speculation. The data shows a massive and growing short interest. As of the last report, over 20 million shares were held short. What you are likely seeing today is a war. The shorts, who are betting on the company's high cash burn and unprofitability, are piling on. On the other side, you have retail traders, perhaps on the Robinhood stock trading platform or Interactive Brokers, who are excited by the news, new announcements of drone ventures and defense contracts. This creates a powder keg. Every press release is met with a surge of retail buying, which the shorts then sell into, driving the price back down. The 4.4% drop today suggests the shorts are winning this particular battle. The stock is a classic target. It has a low price, a good story, or two good stories now, but terrible fundamentals. The FINRA data showing a short volume ratio consistently over 50% confirms that a significant portion of all daily trading is from short sellers. This volatility is happening against a backdrop of extreme financial distress. This company is a serial diluter. That's the harsh reality of online investing in microcaps. In July 2025, shareholders approved a proposal to increase authorized shares to a staggering 900 million. They also approved another potential reverse stock split, even after doing a 1-for-40 split last year. Why do this? Because they need to issue more and more shares to stay alive. The 12 million public offering they just completed in September is a perfect example. That offering was done at 0.1428 per share. So anyone who bought in that offering and is still holding is already up significantly. But it came with warrants, which represent even more future dilution. This is the core problem. The company's operations do not fund themselves. They are entirely reliant on the capital markets, on selling stock, to fund this new defense strategy. This isn't like buying Apple stock or Tesla stock, which are cash flow machines. This is a bet that the new M&A strategy will create a profitable company before the dilution and cash burn drive the stock to zero. Now, let's talk about this pivot. It is all the company is talking about. Press releases from October 16th, October 22nd, they are all about defense, drones, and acquisitions. The Maddox Defense JV announced on October 22nd is the latest catalyst. The company projects this JV could reach $100 million in annual revenue by 2028. This is the expectation part of the new narrative. It's a huge number, but the reality, buried in the fine print, is that these are projections. These are anticipated revenues. And the JV requires Nuburu to contribute up to $10 million in capital funding. This is the part that should make any self-investing individual pause. Where's that $10 million coming from? They just raised $12 million in September, and their cash position was stated at $6 million after that. The math is tight. They are trying to buy their way to revenue, but they are using an incredibly weak currency, their own highly diluted, low-priced stock. This is an incredibly difficult maneuver to pull off. It's not a straightforward investment in a growing business. It's a bet on financial engineering. This kind of trading is not for the faint of heart. The tools on a Fidelity trading platform or the charts on a SoFi trading platform might show technical patterns, but on a stock with this kind of volume churn and narrative shift, technicals are almost useless. This is pure news-driven momentum trading. You're not managing a long-term investment health portfolio here. You're placing a bet at a casino. It's a world away from the stability of Fidelity mutual funds or SoFi ETFs. This is the deep end of the online investment pool. This brings me to a question for all of you watching. Comment below with your take. Is this defense pivot a brilliant strategic move, or is it a desperate last-ditch effort? Let me know what you think. The institutional analysis, as we've seen, is non-existent. The big Fidelity wealth management firms and Fidelity brokerage advisors wouldn't touch this. It's entirely in the hands of retail and short sellers, which is why the swings are so violent. Even the Fidelity mobile app's newsfeed is likely just reprinting the company's own press releases, which paint the expectation, not the underlying financial reality of the cash burn. So, for those who are completely lost, let's briefly rewind. What was Nuburu? Before this defense pivot, their entire identity was built on their blue laser light engine. The science is compelling. In physics, the blue light wavelength is absorbed much more effectively by materials like copper and aluminum than traditional infrared lasers. Infrared lasers tend to reflect, causing spatter and inefficient welds. Nuburu's tech, in theory, provides a clean, fast weld. This is a huge deal for EV battery manufacturing, where you have to weld thousands of tiny copper and aluminum joints. The company has over 200 patents. This is the expectation that formed the company's foundation. The reality? That business model is a slow, expensive grind. Their revenue from this has been minuscule. In 2024, revenue crashed surged to just $152,000 from $2.1 million the year before. Management themselves admitted the adoption cycle for a new customer is 22 to 24 months. They don't have that kind of time. They are burning cash. So, the blue laser business, while technologically interesting, has been a commercial failure. That is the reality that forced this new defense pivot. They are essentially abandoning their original business model, or at least sidelining it, in a bid for survival. Looking ahead, the future for Nuburu is a genuine binary outcome. Scenario 1 is the bull case, the new expectation. This is the narrative the company is pushing hard. In this scenario, the acquisitions of Tekne and Orbit actually close. The Maddox Defense JV lands a real multi-million-dollar NATO contract. These new defense-related businesses are already profitable or can be made profitable quickly, and they start generating real cash flow. This cash flow then, in theory, stops the financial bleeding. The company successfully transforms itself from a failed R&D firm into a diversified mid-market defense contractor. If this